Right now, as we scrutinize the market tape on this volatile Monday morning, December 8th, Beyond Meat Inc. is trading at exactly $1.17 USD. The screen is flashing a painful red, with the stock down $0.048, which translates to a decline of 3.93% regarding intraday movement as of 10:39 a.m. GMT-5. When you see a stock that once traded above $230, a stock that was once the crowning jewel of the IPO market and the darling of the sustainability movement, sitting at barely $1, it is a sobering moment. The expectation for Beyond Meat was that it would do to the food industry what Tesla stock did to the auto industry. The expectation was total disruption, a complete shift in global protein consumption. But the reality we are staring at today at $1.17 is a fight for survival. This isn't just a dip, this is a distress signal. The drop of nearly 4% today suggests that the market is beginning to price in scenarios that shareholders terrify to think about: restructuring, massive dilution, or worse. The plant-based premium has evaporated, and we are left with a company burning cash in a high-interest rate world. To understand the texture of this 3.93% drop, we have to look at the psychology of the holder at this level. If you are watching this on your Fidelity mobile app or tracking the ticks on an interactive broker's trading screen, you are likely seeing capitulation. We are in December. This is tax loss harvesting season. Investors who have held on to this stock hoping for a miracle are finally throwing in the towel to offset gains elsewhere. They are selling to claim the loss on their taxes. This structural selling pressure is relentless. It doesn't care about the fundamentals, it just wants out. The volume today is heavy on the sell side, indicating that there are very few bids stepping in to catch the falling knife. The dip buyers, who usually frequent Robinhood stock trading forums, have been burned too many times on this name. They are wary. They know that a stock trading at $1.17 is flirting with the dangerous sub-$1 zone, which brings up the threat of NASDAQ delisting notices and reverse stock splits. The narrative here is a brutal lesson in expectation versus reality. The expectation was that health-conscious consumers and environmentalists would pay a premium for fake meat forever. The reality was that inflation hit, and consumers realized that paying $9 for 2 plant-based patties was a luxury they couldn't afford when real ground beef was half the price. Furthermore, the health halo slipped. Questions about the ingredient list, processed oils, sodium, stabilizers started to erode the health argument. Suddenly, Beyond Meat wasn't just fighting the cattle industry, it was fighting its own identity crisis. This identity crisis is what is weighing on the stock today. The market doesn't know if this is a growth tech company or a struggling packaged food company. At $1.17, it is being priced like a distressed asset. I want to pause here and ask you guys a genuine question. It is vital to the thesis. Comment below. When was the last time you actually bought a Beyond Burger? Did you stop because of the taste, the price, or the health questions? Or are you still a loyal customer? I want to see if the anecdotal data matches the sales charts. Let's compare this to the broader market. When you look at Apple stock or Nvidia stock, you see companies with pricing power. They can raise prices and people still buy. Beyond Meat discovered the hard way that it has zero pricing power. When they tried to keep prices high, volume collapsed. When they discounted, margins collapsed. They are caught in a vice. For clients using Schwab Intelligent Portfolios or seeking investment help, this stock is often used as a case study in product-market fit going wrong. It reminds us that just because a product is innovative doesn't mean it is a sustainable business. Fidelity Wealth Management advisors are likely steering clients far away from this name, classifying it as highly speculative. The intraday dynamics today also hint at short seller activity. Beyond Meat has always been a heavily shorted stock. The bears believe the equity is worthless. Today's drop of nearly 4% could be shorts pressing their advantage, smelling blood in the water. They know the company has debt coming due in the next few years. They know the cash burn is still an issue. If the stock drops below $1, it triggers a psychological breaking point. It becomes a penny stock officially. Many institutional charters prevent fund managers from holding stocks under $5 or $1. As the price drifts closer to $1, these funds are forced to sell, creating a self-fulfilling prophecy of decline. You can see this on Interactive Brokers, where the borrow fee for shorting the stock remains high, indicating that the demand to bet against Beyond Meat is still incredibly robust. Let's talk about the cash position. This is the only metric that matters right now. If you are engaging in self-investing or looking to invest online, you need to learn how to read a cash flow statement. Beyond Meat has been burning cash to keep operations running. They have cut costs, laid off staff, and reduced marketing, but they are still bleeding. The reality is that they are in a race against time. Can they become cash flow positive before they run out of money? The market, pricing the stock at $117, is voting no. Or at least it is voting that the solution will be highly dilutive, meaning they will have to sell millions of new shares at this rock-bottom price to raise money, wiping out the value of existing shareholders. This is the death spiral financing risk that keeps the price suppressed. But is there a contrarian angle? Is there a world where $117 is the buy of the lifetime? The expectation is bankruptcy. If the reality turns out to be a strategic buyout, the stock could triple overnight. Imagine if a giant like Kraft Heinz or Tyson Foods decided they wanted the brand and the patents. They could pay $3 or $4 a share and it would be pocket change for them. This buyout option is the only thing keeping the stock from going to 50 cents. Investors holding on SoFi Invest or Robinhood are essentially buying a lottery ticket on an acquisition. They are betting that the brand name, which is still very famous globally, is worth more than the enterprise value currently implies. Let's look at the product innovation. They recently launched the BYND platform, using avocado oil to improve the health profile. They are trying to fix the processed perception. The problem is it too little, too late? The grocery aisles are crowded now. There are cheaper generic versions. There are competitors like Impossible Foods. The moat has dried up. If you are using Fidelity ETFs that track the consumer staples sector, you will notice that the giants like Pepsi and Coke are doing fine. It is the niche, high-growth disruptors that are getting crushed. The market is currently favoring stability and dividends over growth at all costs, and Beyond Meat offers neither. The retail trader dynamic on Robinhood crypto and stock forums here is interesting. There is a sense of betrayal. Many retail investors bought into the mission. They wanted to save the planet. Now they are holding bags that are down 95%. This creates a layer of overhead supply. Every time the stock ticks up to $1.50 or $2, these trapped investors use the opportunity to get out at a smaller loss. This creates a ceiling on the stock. It is very hard for a stock to rally when everyone who owns it hates it and wants to sell. To break through this, Beyond Meat needs a massive catalyst, something that changes the fundamental equation, like a new massive partnership with McDonald's that actually works, unlike the McPlant test which largely sizzled out in the US. Let's discuss the reverse split possibility. If the stock stays near $1 for too long, NASDAQ will send a deficiency notice. To fix this, companies often do a reverse split, say exchanging 10 old shares for one new share. The price goes from $117 to $11.70, but you have 10 times fewer shares. Mathematically, it is neutral. Psychologically, it is a disaster. It is an admission of failure. It often signals to short sellers that the company is desperate. If you hold this in an individual brokerage account, you need to be aware that a reverse split often leads to further selling post-split. It is rarely a bullish signal. The macro environment isn't helping. Interest rates are the enemy of unprofitable companies. Beyond Meat carries convertible debt. If they need to refinance that debt in this environment, the interest rates will be punishing. The expectation in 2020 was that money was free forever. The reality in 2025 is that capital has a cost. This cost of capital is strangling their ability to innovate and market their products. They have to play defense when they should be playing offense. If we look at the international markets, there is a glimmer of hope. Beyond Meat is doing better in Europe, where the consumer is generally more open to plant-based diets and the regulatory environment is friendlier. They are expanding in Germany and the UK. But can the European growth offset the American collapse? The U.S. market is the engine. If the U.S. consumer has moved on, the company is in trouble. The price of $117 reflects a U.S.-centric pessimism. For those of you using investing sites to research, pay attention to the insider trading data. Have the executives been buying at these lows? If the CEO and CFO